All right, here we go. This is my favorite topic to talk about because nobody does this well. And I happen to think I do it really well. Now, I'm going to tell you up front, if you can digest this information, this can save you from a really terrible situation. So many people sell indexed universal life policies the wrong way, and it results in you paying higher fees, having less cash, and ultimately lots of regret. So every time you get online and you see people bashing life insurance and talking about how it's too expensive, it doesn't work, the reason that they're saying that is because most people do it wrong. And I'm going to prove it to you right here, right now, with some real life examples. Again, this is Matthew Decker, Wealth Architects Radio. This is video 2 in a series of 3 on Indexed Universal Life. The last video that we poured through was all about crediting on Indexed Universal Life contracts. If you haven't seen that, check that out. But as a recap, the 3 videos that pertain to Indexed Universal Life in this series, the first one was crediting, like we mentioned. Today we're talking about fees. I love it. And then the last video is going to be access to money. How do you access your money? So let's go ahead and get right to it. Fees. All right, so there are quite a few different fees on Indexed Universal Life contracts, and this is, for the most part, applicable to every single IUL contract that you could take a look at. So let's break them down real quick, and then we'll go through them one by one. Number 1, there's a premium load. Number 2, you have the cost of insurance. You also have what's called an expense charge, a per face fee, a per unit charge, or a per thousand charge. Now, all of those are the same thing, but they're called different things on different policies. We'll go into more detail on that in a little bit. And then the other thing that you might see is any rider charge. Okay, now there's only going to be a rider charge if you've added riders, but again, we'll get to that in a little bit. So let's first go through premium loads. Super simple. A premium load is just going to be a fixed percentage fee that is based on how much premium you pay. Now, typically that fee is going to range anywhere between 4 and 8%. Some are higher, some are lower. It just depends on the carrier. And again, you're only going to pay that fee when you actually pay a policy premium. If you're not paying premium, there is no premium load. That's it for premium load. Super simple. Very straightforward. The next one is cost of insurance. Now, here's where it starts to get a little bit tricky. Cost of insurance is going to be based on how old you are and what your risk class is. So, were you preferred, standard, were you a smoker rating? All of that is going to affect your cost of insurance. So, here's where it starts to get interesting, and here's where we get into dealing with people that really have no idea what they're talking about, or they're being a little bit facetious. So I'm sure that you've heard insurance is expensive. These policies get more expensive every single year that you live because they're based on your current age. That's partly true. So the question that you should be asking is, does the cost of insurance really go up every single year? Now, as an aside, this is a great opportunity for me to talk about the Bad Advisor ebook that I put together. You should absolutely take advantage of that. Download it right now. It's free, but there is tons of great advice in there on how to spot and stay away from bad advisors. Why am I talking about that now? Because bad advisors get this wrong all the time. So does cost of insurance go up every single year? Well, the answer is yes and no. It's kind of complicated. See, your cost of insurance is actually going to be based on something called the net amount at risk. Okay, what's net amount at risk? I know this is getting really nerdy and I'm sorry, but net amount at risk is what's your death benefit, and then you subtract out your current cash value. So if you have a policy that has $1 million death benefit and no cash account at all, your net amount at risk is pretty simple, $1 million. Let's say you have $1 million policy, but you have $500,000 in cash. Well, your net amount at risk is now $500,000. Death benefit minus your cash value, that's your net amount at risk. Now, advisors get it half right because what they say is that the cost of insurance goes up every single year. That's only half true because they're forgetting something. The cost of insurance goes up stay with me now, it goes up per $1,000 of death benefit that you're buying. So the cost of insurance does go up dollar for dollar in terms of how much death benefit you're actually buying. But what does the net amount at risk tell us? Well, the net amount at risk tells us that you're not actually buying $1,000,000 in death benefit if you have $750,000 in cash. In that instance, you're only buying $250,000 of death benefit. So if your net amount at risk is going down, it's very likely that your costs from year to year are going down. Now, if you have a really good advisor, they're going to know that, and they're going to design your policy so that it functions that way. If you have a really terrible advisor, they may stumble across it on accident, but they certainly couldn't explain it to you. So let me do it one more time because this is important. Your costs every single year do go up based on how much insurance you're buying. But if you're working with somebody who knows what they're doing, they're going to make sure that your policy is actually buying less insurance every single year because your cash will be growing substantially. If your cash is growing substantially, your costs might actually come down year over year. We'll go through an example at the end of this presentation, but cost of insurance, it's one of the larger fees on the policy. There's a lot of misconceptions about cost of insurance. Okay, moving on. Let's talk about that expense that has 4 or 5 different names. We're going to call it the additional expense charge. You might also remember it as the per phase fee or the per unit charge. This fee is actually the largest fee on these life insurance contracts. Now, it only stays on the policy in most cases for 10 years. Not every company does this, but just about every company that's reputable, that's A-rated, that has a good product, they have this fee on the policy for 10 years. After 10 years, it goes away, and again, it's the largest fee on the policy. We'll look at an example of this when we go through the actual numbers. But the important thing to remember is it's going to last 10 years. So what does that mean? It means that these policies are front-loaded. The largest fee is a 10-year fee. After that, it goes away. It's a front-loaded contract. If you're trying to do something inside 10 years, this might not be a great fit. If you can wait 10 years and get past this fee, it's a beautiful thing, and you'll see what I'm talking about. Rider charges, super simple. It's only going to apply if you add special options. So this is going to be things like long-term care riders, first-to-die riders, waiver of premium riders. I'm not a huge fan of a lot of those riders, but certainly there's a place for them. Though if you're trying to build as much cash as possible, you're probably not going to be throwing on a ton of extra riders. All right, so let's look at some examples of actual policies and breakdowns of the fees. This might be what you'd see on an annual statement. And what we're going to do is we're going to actually look at 2 comparisons side by side. I told you that most advisors don't know how to structure these and that you should be on the lookout for those advisors. So what we're going to do is we're going to show you the difference in working with a good advisor versus a bad advisor, what you're going to pay in fees based on who you're working with and how much money you end up with at the end of the day. So 2 examples side by side, and I think it's going to be pretty telling. So this is the exact same company, the exact same product. We're paying the exact same premium. You've got the top, you've got the bottom. This is a 55-year-old male, standard risk class. Okay, nothing special going on. We're paying $30,000 a year for 14 years. So $30,000 a year for 14 years in both cases. And you can see the premium and the premium load are exactly the same. They're identical. It's the same contract. This is all in how we structure the contract. There's no more premium dollars going into one or the other. That's not what we're doing here. There's no funny business going on. It's essentially the exact same contract. One is structured to be efficient. The other is structured to pay the agent as much as possible. And I think you'll see which one it is. So since the premium load is identical, let's just kind of do away with that column. What I really want to focus on are these 2 highlighted columns here, cost of insurance charge and additional expense charge. Okay, the first thing that you're going to notice, or the first thing that I want you to notice, look at the additional expense charge column. You'll notice for the first 10 years, this fee is kind of huge, $4,900. $5,000, $5,000, $5,000, so on and so on. But then you'll notice that it virtually goes away after year 10. It goes from $5,600 to $434. Now it does the exact same thing down here on this other example. It goes from 3,500 to 500. Okay, so there's the first proof in the pudding. I told you that that expense charge was a 10-year charge. It goes away after that. There you can see it. Virtually gets completely diminished in this contract. Now the reason that it's still on there is just it's simply the way that I've structured this. In some instances, it goes away completely and it's $0. It just happens to be with this product, it stays on in a diminished capacity. So what I want to do is I want to focus on the total fees that we're paying on top versus the total fees that we're paying on bottom. So on top, we've got total fees of $200,192. And all I did was I added up cost of insurance and additional expense. I did not include the premium load in this because the premium loads are the same in each instance, so that doesn't matter to us. $200,000 on top. On the bottom, I structured it differently. I made it as beneficial for the client as I possibly could. And it results in about $70,000 less in fees, $132,000 in fees versus $200,000 in fees. That's a huge difference. If you go to the bottom there, you'll notice I've got $1 million in my surrender value at age 77. Up on top, $841,000. So just by structuring this contract the right way, I've added almost $200,000 in additional cash for the client just by structuring it the right way. That, ladies and gentlemen, is the reason that you have to be working with somebody who knows what they're doing. So I don't need to tell you. The one on top is obviously the wrong way to do it. Bad advisors do this all the time because it maximizes their commission to structure a policy like it's structured on the top. Obviously, the bottom is the right way to do it. Not many people know how to do this the right way, and if they do, they can't explain it to you. So I want to take it one step further because still I can tell some of you are seeing this and you're like, oh my gosh, that's a lot in fees, $130,000? That's crazy. Why would anybody ever do that? Well, let me prove to you that you may not be thinking about that quite clearly. So here's what we're going to do. We're going to compare that exact same policy on the bottom. This policy on the bottom, I'm taking those numbers and I'm transposing them onto a graph, okay? And what we're going to do is we're going to compare those values to what a money manager may charge you to manage your money. So what we're doing is we're looking at a 1% management fee and a 2% management fee. Now I know some of you are going to say, well, why are you going to a money manager, invest in no load index funds? Yeah, I get it. Okay. We're not comparing no load index funds with unlimited upside and downside risk to a life insurance policy. They're two totally different vehicles. You can't compare the two, okay? We're comparing something like maybe a tactically managed fund, something where somebody's watching it, they're trying to minimize your risk, maximize your return. You pay a fee for that no matter where you go. There's no such thing as a tactically managed, no load mutual fund. It doesn't exist, and if it does, it's not good. Okay, so that's out of the way. So what I did on the IUL charges, this middle column here, is I took all the fees on the life insurance contract and I just added them up, condensed them into one column. I did that just so it's easier to look at. So that's all the fees on the policy. That's the COI charge. That's the per face fee. That is the premium load, and that's any admin fees that might exist. Typically they're $90 a year, nothing special, but they're all condensed into that one column. And then I also am showing you the account value here on the life insurance contract, and I'm showing you the premium that we're paying. So you'll notice if you put this money with a money manager at 1%, $276 in year one versus $5,200, which would you rather pay? Well, obviously you'd rather pay $276 versus $5,200. That's a no-brainer. And I completely agree with you. Even at 2%, $552 versus $5,200. I mean, what the heck? Why would anybody ever do this? Well, go down to the bottom. You'll notice lifetime fees. So this is at age 90. If I took these numbers out even further, it would just get even uglier for the money manager. $238,000 in total fees by the time you are age 90 if you start at 55. Okay? If you're being charged 1% to manage your money, which is low for a tactically managed fund, which I'd recommend just about everybody who's getting close to retirement at least consider, you're paying $100,000 more in fees at 1%. Now, I don't think you can find a good tactical manager to manage your money at 1%. Most of them are 2.25%, 2.75% even. Some of them are up above 3%. So let's just say it's 2%. A good tactically managed fund at 2%, you're paying $671,000 in total fees by the time you're 90 years old. You're still subject to market risk. You pay those fees whether you make or lose money. They are what they are. They're not going away. Which would you rather pay? $238,000 for something that has no market risk, but maybe a 12, 13, 14% upside, plus you get life insurance that goes tax-free to your beneficiaries if something happens to you? Or would you rather invest completely in the market, unlimited upside, unlimited downside? If you die in year one, your beneficiaries are going to get, $27,000, $30,000. You die in year one with a life insurance policy, they're going to get, $500,000 maybe, $1 million. So this is not to say that a life insurance policy is better than a managed fund. I'm not saying that because I don't think that that's true. But what I think is when people talk about fees, they have no idea what they're talking about. None. You now know more than 99% of the financial planning services industry. I mean that. Insurance agents out there don't know this. You know more than they do now. Financial planners don't know this. You know more than they do now. CFPs don't know this. You know more than a CFP at this point in time. They do not know this. They don't understand it. They don't want to take the time to learn it because they think it's too hard. And that's unfortunate because that's how you get bad advice. So let me end plugging the handout that I have on bad advisors. You can get that for free at the link below. It's in the description. You can see it here on the screen. Take advantage of that. It's absolutely free. I put it together so that you can spot bad advisors from a mile away. You go through that, you'll know more than 99% of the industry. You already do. You've seen the first 2 videos here. You're going to watch the third one. You're going to be an expert on this stuff. Stick with me. Keep coming back. Keep learning. Keep digesting all this information. My goal is to make this easy, to boil it down, to crystallize it for you, to make it digestible so that you can learn something, feel good about what you've got, realize that you're working with the wrong agent, realize that maybe you're working with the right agent. If he knows this stuff, great. That's perfect. But I hope you found this valuable. Again, it's Matthew Decker, Wealth Architects Radio. Take advantage of that free handout on the bad advisors. You can get it below, and I look forward to seeing you soon.